What's up, y'all? Today I'm going to be talking about one of the biggest mistakes that I see people making whenever they're trying to fix their credit report. So if you're interested in figuring out what to avoid, stay tuned. What's up, y'all? I'm Tomy Boboy, your credit and personal finance coach. If this is your first time on my channel, I'd just like to say welcome. Typically on this channel, I'm talking about things related to credit and personal finance. So if you're interested in achieving financial freedom or improving your credit, be sure you hit the subscribe button down below so you don't miss any of my future videos. Now let's jump into what mistake you want to avoid. Now, one of the biggest mistakes that I see people making is that they go to their credit report and just try to get rid of everything, right? Removing accounts from your credit report without having a plan in place is what leads to you having a bad score, maybe even worse than what you had when you started. There's a lot of different factors that you want to take into account before you decide to actually delete accounts off your credit report, right? Because the history of the account that you're deleting could be actually helping you more than hurting you, even though it might look like a negative account. Keep this in mind. People who have nothing on their credit reports have bad scores too, right? So by you deleting everything off of your credit report, you're going to be in the same situation as them. So maybe let's say your score did go up a little bit. You're going to be in a worse off position because now you have straight up nothing on your credit report for you to be able to work off of. And with that said, one thing I want to touch on is the fact that there's some credit repair companies out there who offer things called credit sweeps, or, they have different variations of names that they like to call it, but they'll tell you things like, we can delete all your negative items within 14 days, or we can delete all negative items in 30 days flat, right? And one thing about that is, to kind of give you an idea, like what's happening behind the scenes is they're basically just declaring fraud on all the accounts all the accounts on your credit report, right? So their idea is, I'm just going to declare fraud. And then what happens is whenever they declare fraud, the credit bureaus now have to basically verify all that information, right? And they're relaying that information to whoever the furnisher of that information is, right? So, if it's like let's say you had a Trace credit card or something that was a charge off, if you declare fraud on it, then the credit bureaus are going to take that off of your credit report, and then they're going to reach out to Chase to let them know that it was fraud. And then that's whenever this whole process is going to get started, right? They're going to start, doing their fraud investigation. So the idea is, those credit repair companies will do these credit sweeps. It'll wipe it off of your account for a little bit, right? While they're doing this investigation. But the issue is it always comes back, right? Of course, that account's going to eventually come back because they're going to do the research and see, oh, it's his account. But the thing that makes it even worse is once you've declared fraud on the account, you can assume that it's not going to get removed anymore. Like, there's no way that you're going to tell them that this account was fraud and then be able to dispute that account any other way, right? They're going to keep on file that you claim that it was fraud, and any type of disputes that you do about the account they're pretty much going to ignore it at that point. And the even worse part is you are not liable for fraud, right? Because you're claiming that it was identity theft when it wasn't. And the thing is in this situation, you got to keep in mind that it wasn't really you, right? It was a credit repair company that did it for you, but they did it on your behalf, right? And so, it's possible they might get in trouble, but of course the authorities are going to come after you first. They're going to say, hey, you're the one who declared, identity theft on these accounts. In some cases, some of these credit repair companies will even have you file police reports and things like that, right? So now you're even making false statements and things like that, right? So it can really drag you down into a hole, and it's something that you just don't want to get involved with. So always make sure whenever you're dealing with credit repair companies, if they're offering services telling you like they can guarantee that these accounts are going to get removed within 30 days, whatever it is, those are the kinds of companies you want to avoid no matter what. So what should you do instead? The big thing is you want to first have a game plan, right? You want to kind of have an idea what you're trying to get accomplished, what kind of score that you need. So let's say, for example, you're currently at a 600, but you want to get to a 650. So now you want to kind of think about what can you do to just get your score up those 50 points that you need, right? And that, I think, is the best way to look at it, especially whenever you're looking at different accounts on your credit report. A few accounts that you want to avoid is, if you have an account that, let's say, has a few late payments. Let's say you were 30 days or 60 days late a few times on an account that you've had on your credit report for like 10 years. Okay, it's an active account. You've had it for like 10 years and you've just been late a couple times. It might not make sense for you to try to get the whole account removed, right? Because you have that account on there. it's still giving you positive, it's still giving you some positive information in terms of it's a 10-year-old account, so that's helping. Even though you've had a few late payments, if you've had it for 10 years, think about all that positive payment history that you have on the account, right? It's more than likely it far outweighs the negative payment history that you currently are putting on that card. So it's things like that that you wanna keep a lookout for. Even, for example, like if it's an account that's really, it's like a 10-year-old account and it's a charge off. Maybe it might make sense not to remove the account because it might be a charge off, but it had good payment history. It's just you fell behind on making payments, in the last year, right? In the last year, you missed payments for 6 months, and so they charged it off. But if you look at the other 9 years, you were making your payments every single month, never missed a payment. That might be an account that you want to keep on your credit report because it still has some positive history. It's things like that. You kind of just have to make or use your best judgment when it comes to things like that. So now I kind of want to give you a few categories that I've kind of written down here that to give you a better understanding of how your credit score actually works. So if you've watched my previous videos, you know that your credit score is really broken down into 5 categories, right? First category is payment history, 35% of your score. Next category is credit utilization, or amounts owed, basically how much of your credit cards you're using. That's worth 30% of your score. Length of credit, so how old your accounts are on your credit report, is 15% of your score. Your credit mix, so what types of accounts that you have on your credit, is 10%, and then credit inquiries is another 10%. I think that you should try to focus on the bigger parts of your score, right? I have a thing called the rule of 65. I think that you should focus on the first 2 big sections, the amounts owed section, which is 30%, and the payment history, which is 35%. Because by you just focusing on those 2 scores, you will be able to see a lot faster of an improvement, as opposed to you just trying to attack every single little thing that's on your credit report. So the first part that's probably the easiest is credit utilization. This is the easiest to really affect, is because all it has to do with is how much of your credit card you're using. So if you have let's say you maxed out your credit card. Let's say you have a $200 credit card and it's maxed out, and that's the only credit card you have. You're losing a big part of your score, because this is 30% of this category is 30% of your score. So by you just paying off that $200 credit card, boom, you could see your score shoot up like crazy, right? So I typically recommend you attack it 2 ways, right? First off is paying off credit card debt, right? That's the obvious choice. So pay down as much of that credit card as you can, and then you're going to see your score is going to keep increasing. Another option is adding more credit, okay? And what you can do is you can just, start adding credit or increasing your credit lines. Let's say you already have a credit card and trying to get a credit limit increase, things like that. Because now, instead of let's say, for example, that you have a credit card that's $1,000 limit, but you owe $200 on it, right? So you have a balance of $200. That's a 20% utilization, credit utilization. What you can do is let's say you had $100, you could pay off $100 worth on that card and you get down to a 10% utilization, because now you only have a $100 balance. Or you can try to either add another credit card or increase your credit limit. So let's say you were able to get access to another $1,000 in credit, right? You have another $1,000 in credit, but you didn't pay off your credit card. So you still have the $200 balance. Well, that's still going to count as a 10% credit utilization, right? So you can kind of attack it at both ends, right? By increasing your credit limits and lowering your actual balances on the cards. And that's going to be able to give you the most success, okay? Now, for those of you guys who are in the situations where maybe you can't get a credit increase, or you don't have credit cards, whatever the situation is, I've shot videos on how to get secured cards. I'll attach it down below, as well as I have videos on how to get store cards, right? They're like instant approval, $5,000 credit lines, things like that. I'll link to those down below for you to check out. The next section is going to be payment history. So payment history, again, is a 35% of your score. This one's a little more complex because there's a lot going on. What I recommend is you try disputing any negative payments that you have, right? So, try to get the negative payments either by sending goodwill letters to your creditors, right? Asking them just to remove the late payments, or you can just try to dispute those late payments, or also getting rid of any type of collections accounts, okay? So if you have any collections accounts, then that counts as part of your late payments category as well, right? Pretty much any derogatory accounts where it's like after you don't pay for a while, then it turns into like a charge off, repo, foreclosure, whatever it is. Those can negatively impact this part of your score as well, okay? So Yeah, I've shot videos on all that stuff. I'll link to it down below. I shot videos on how to remove collections, how to deal with late payments, how to remove charge-offs, all that stuff. I'll link to it down below so you're able to check those videos out if that fits your specific situation. Okay. Now, on top of that, what you can do is you can actually just also add positive payment history to your credit report. Okay. So I think you should, again, just like we were talking about the credit utilization, you want to attack it from both ends. Try to get rid of the negative accounts or the negative accounts and negative payments. And also try to add positive history. So make sure you're not missing any payments going forward. Like any payments reporting to your credit reports, you want to make sure that you're not missing that payment. And you want to make sure that you're adding new payments. So if you have a card that you just opened or you want to open another card, that'll increase and make sure that you're adding positive payment history. Now, the next thing is going to be length of credit. That's going to be 15% of your score. And that just has to deal with, it's a lot harder to kind of control and move around. It really just has to do with not closing accounts. Okay. So I always say, like, keep your credit cards open unless you have annual fees, right? If you're not paying any type of annual fees, then it doesn't hurt you to keep that account open. Now, another option is, because I've had cards where I've had annual fees, and one option that I did do was I just talked to that company, that credit card company, and try to talk to them and see if they could downgrade me to one of their like lower tier cards. So for example, if you have a card, right, and it has an annual fee and you talk to them and they downgrade you to, let's say, a bottom tier card where they don't have any annual fees, then what they'll do is they'll keep that same account open on your credit report. It'll just change the name of the account, right? It'll just change the name as another credit card, right? But it's still going to keep that same account age and everything. So the account would really never gets closed. Now, the next part of your score is going to be the credit mix. 10% of your score, you can't really do much with that. I mean, I'd probably say it's just adding different types of accounts. So, adding things like installment accounts and credit cards or revolving accounts. So, whether it's car loans, having a mix of credit cards, things like that, right? So you just want to make sure that you have all those different angles of it. And the other one is going to be hard inquiries. This one's just a lot harder to control as well. But you can always you just want to make sure you don't apply for too much credit. And, you got to look at it from the bank's point of view, right? If you're applying for credit, how does that look to a lender? Like, I like to think of it this way. Think about whenever you are, let's say that you had a friend, right, that asked everybody in your friend group for money, but everybody said no. And then he turned to you and asked you for money. You're going to be a lot more skeptical to give him money because he just got rejected by like 5-10 other people. Right. So you might not know exactly what's going on with his situation, but just by you seeing that he got rejected by those other guys or by your other friends, it's going to make you a little bit more skeptical. And that's kind of how the banks are. If they see that you have a bunch of inquiries, they're just going to assume you're just out here trying to get chase money wherever you can. And it's going to make them want to reject you, too. So you want to avoid having too many inquiries. And that's really the gist of it, right? If you can just incorporate some of those into whatever your game plan is, you're going to see that your score is going to be able to increase significantly. Okay, so just go ahead and try to take action on those. I kind of talked about what the most common mistake was just deleting random accounts. But if you can avoid that and actually create a game plan, then you're going to have a lot more success than you would in any other position. Okay, so that's going to be the gist of it, guys. Be sure that you throw a like on this video if you found this information valuable, and also make sure that you hit the subscribe button down below so you don't miss any of my future videos. Alrighty, so that's going to be it for this one. I will see you at the next one.